Morning to you all. Yeah, I think FTSE, I mean, it did make a big break last week, but it has been in the most ridiculously confined range. And it's pretty unheard of for a new administration. Yeah, morning to you, Richard, and you, Gary. Pretty unheard of for a new administration to come in and wait 16 weeks before delivering its budget. So we've still got another, was it week and a day, 8 days to go? And I've got a few mates that are fund managers in the business, managing quite chunky sums, and they've had to sit on their hands literally for the last 8 weeks. You know, they're worried about investing in banks, they're worried about investing in the energy sector, they're worried about investing in the gambling industry, etc., etc. Banks, could they be hit as well? Last week, we had some better than expected CPI data. What was it? Was it Wednesday last week? Yeah, Wednesday last week, if you remember, 1.7%. Gosh, bit different from 11.1. Yeah. So inflation continues to tumble, energy, petrol prices, and some food items as well, dragging it down to a 3-year low. 2.2% the previous month, was expected at 1.9, 1.7. Anyway, all those interest rate sensitive stocks jumped on the FTSE 100, banks, house builders, all enjoying the analysts' suggestion that the Bank of England is almost certain to cut rates by 0.25% in November and another 0.25% in December. And that's partly explains the move on the foreign exchange markets as well, where you've seen sterling crumble or continue to crumble. Yeah. So that was that. Other big moves last week. We had what was it? Yeah, we had the European Central Bank. They've got in headline inflation as well, 1.7%, now below their target. You've got weak data coming out of the Eurozone, and that's really what pushed the ECB into the inevitable rate cut last week. So another 0.25% interest rate cut. Had you missed it? Here we go. The main, well, this is the refi rate, but it's the main deposit rate was cut 0.25%. So that's the second in a row, and that's I think that's the first time that's happened in back-to-back meetings since 2011. Interesting, though, isn't it? So the European Central Bank is a bit odd in some ways. They just sort of keep reiterating the idea that it's data dependent and it's our meeting by meeting approach, and that's a quote from them. And of course it is data dependent, but central banks can give guidance about what they're thinking because it's quite a fluid thing. But the European Central Bank, just to say it's data dependent, of course it's data dependent. Anyway, despite the European Central Bank giving little guidance about last week's cut, I think it was pretty clear that it had to be cut. We've had some pretty poor data. What was it? The PMI data, the manufacturing and service data. In fact, the Eurozone manufacturing and service data, that was reported on the 23rd of September. So we've actually got the same data a month later, so this week coming out. So and that'll be really interesting to have a look at it. But that was far worse than expected, far worse than the consensus, and was particularly worrying for the German economy. Is that what you're referring to, Michael? Germany deciding? It was their decision. They're represented on the governing council, Michael, I think, to say that they made it happen. But certainly Germany, which is the powerhouse engine of the Eurozone, no longer. And the data that came out for Germany last month on these purchasing managers index. So this is where institutions survey purchasing managers to see what they're thinking. Are they buying more or buying less? They're buying more, then obviously they're growing. If they're buying less, they're not growing. and the purchasing managers index, the manufacturing one for Germany, was at 40.3. Now that's the lowest in a year, and just nowhere near where it was when pre-pandemic, when the German economy was absolutely flying. So it's just interesting that Germany, and it's likely to contract, its economy is likely to contract this year. And that's really down to the fact that it's still reeling from the surge in energy costs. And I know you're probably going to say, well, Jerry, inflation's only 1.7%. That's it can't be reeling anymore. No, that means prices are only going up 1.7%. They're not coming down. They're not. Plus, very slow growth in China, which is one of Germany's, or is Germany's biggest export market. Weather in Spain also liable to affect food prices. Gosh, Michael, that's probably true as well. I mean, alongside the increase in transport costs for goods, this is not food items, obviously coming from the Far East that are now having to go around the Horn of Africa. So yeah, there's a few challenges that might cause some central bankers to think, well, yeah, inflation's down, but I'm just not sure it's going to stay down, you know? But it's interesting, isn't it, how things have changed. You know, at the beginning of August, investors were fretting that the US could slide into mini recession. Do you remember in the rather warmer days in August when the non-farm payroll came out in the US? It implied that the labor market had really cooled significantly. All of a sudden, interest rate expectations at the time were pricing in 2 half-point cuts in interest rates by the Federal Reserve. Since then, since those weird days in August, and I just didn't believe it anyway. You know, one bit of bad data doesn't imply a mild recession. Anyway, since then, US economic data has rebounded whilst inflation has continued to moderate. And that's provided investors with what we'd sort of refer to as a Goldilocks scenario, where the economy is neither too hot nor too cold, and where inflation is under control. And that implies continuing economic growth with moderating price pressures. It is that Goldilocks scenario. Anyway, forward interest rates in the US still imply 2 further rate cuts by the end of the year. And we often look at this, don't we, when we're going through the effect on the markets and what's the effect on interest rate expectations. And you can see here, with interest rates currently at 4 3/4 to 5, there's going to be another cut in November, just after the presidential election, so not long to go for that, and then a further cut from 4.5 down to 4.25, 4.25 to 4.5. So a further quarter-point cut. So 2 half-point cuts. But if you contrast that, what's happening in the European Union, analysts now expect there to be 2 quarter-point cuts this year, 2 further quarter-point cuts this year, and another 2 by April 2025. Another 2 by April 2025, which will take the deposit rate down to 2.25%. So there's been a big swing in what investors were thinking about the relative strength of the Eurozone bloc versus the US as a trading bloc. And it's quite interesting how that shifted. Growth, economic data in the Eurozone, it's not good. It hasn't been good for a while. I'm surprised the market has taken this long to price that in. Price pressures in the UK? Yeah, well, we've already discussed it, 1.7%, John. We were expecting, the previous inflation figure was 2.2%. Where was it? We did look at it, apologies. Yeah, so we came in at 1.7%, was last at 2.2. We were expecting 1.9. So yeah, UK headline inflation is falling more than expected. And so interest rates, yeah, all the forward guidance is, the forward swaps are implying 2 cuts this year. Yeah. Lucky us. Lucky us. Well, maybe not lucky. If you've got a lot of money on deposit, just remember, interest rates, relative interest rates affect currencies. If interest rates are not going to come down as much in the US, you will see the dollar rally. And that's what we've seen over the last month. Interest rate expectations have shifted dramatically, which has caused the euro to fall sharply. And also for sterling to fall, but not as sharply as the euro. That sterling has sort of done reasonably well on the crosses. Anyway, there we go. And currencies, well, we've sort of just been referring to it, the recovery in the US dollar, that continues. So we just look at the US dollar. Yeah, we didn't. It was an okay move. I think the euro lost sort of 70 odd pips. Sterling was a sort of pretty flat last week, and the yen also lost ground as well. And that again is down to these forward interest rate expectations, which are implying further cuts in interest rates in the Eurozone and in the UK. Also, it looks like they may well not be raising rates in Japan, and that's another reason why the Japanese yen has continued to weaken as well. Quite volatile markets. Michael. Okay. I'm assuming everyone else can still hear me. Someone's telling Michael's telling me he's having sound issues, but anyway, yeah, welcome back. We were just talking about currencies, Michael. I assume you can all hear me still? Just a quick why would help. Yes? Yeah, okay, that's great, Peter, thank you. Just in case. Don't want to talk to myself. And that is the first sign of madness. Yeah, thank you, Richard. That's kind. Yeah, so I've also been asked about the impact of the presidential election on currencies and on the dollar. And it's quite difficult to know what's going to happen because this election is just on a knife edge. So it's not clear who is going to win, first of all, and it's not clear what Harris's policies are likely to be neutral for the dollar. Trump wants to weaken the dollar to make US goods more competitive overseas. But the policy of introducing all of these tariffs will have the opposite effect. It will cause the dollar to strengthen. At least that's what many commentators think. So it's quite difficult to factor in what's going to happen post the election because you know who's going to get in, and we're not altogether sure what Trump is going to do with these tariffs should he get in. Anyway, yeah, sterling. Well, sterling fell to a 6-week low versus the dollar, but you'd expect that really on the back of very low inflation, which has really caused the forward swaps markets to price in almost certainly 2 further cuts this year. So interest rates going down to, well, they're currently, what, 5% at the moment, so going down to 4.5% would be the result of that. Commodities, gold. Wow, yeah, gold is just new highs, new highs, new highs, and a lot of overseas buying, a lot of buyers in China, India, and obviously what's going on in the Middle East. It's quite a global macro event that it is destabilizing. But look at oil. If it's causing gold to go up, why isn't oil going up? You know, we've been waiting for Israel's retaliation against Iran, but to date, there's been nothing. You know, there's a lot of speculation that they're practicing what they're going to be doing with their ground troops, apparently, according to the US's intelligence. But what's clear is that Israel has heeded Biden's advice and won't be targeting Iran's atomic and oil energy structure. And I think that's infrastructure, and that's the reason why oil has come back. I think the straw that broke the camel's back last week was probably the lack of any clarity from Beijing on the economic stimulus measures announced a couple of weeks ago. And then to compound Beijing's problems, you know, the recent inflation and PPI data in China suggests that deflationary risks in the economy persist. Deflation, that's where prices are falling. And I can hear you thinking, Well, deflation. I thought we didn't like inflation. Deflation, is that a bad thing? Every economy needs inflation. What we don't want is what happened over the last 3 years is unchecked, out of control inflation, where we saw inflation in the UK get up to 11.1 and in the US getting above 9%. Yeah, we don't like that. But you do need, as a business, you do need the ability to raise prices. So with inflation of 2%, it's possible businesses can raise prices, but not in a deflationary period. And if you can't raise prices, it's difficult to increase revenues, and it's difficult to be able to plan capital expenditure to expand your business. Yeah. So that's the problem they got in China, in Beijing. Plus the GDP data that was announced last week, 4.6%. That was the lowest in, I think 18 months. Yeah, a year and a half. It was the lowest in 18 months. So it's not good. Things are not good in China. Yeah. Anyway, and the reason why oil's come off on the back of all of what I've just said is China is the largest oil importer in the world. And so obviously its misfiring economy implies lower oil consumption. Yeah, hence the reason why oil continues to struggle with news from China. Okay, right, let's get on and go through the calendar. Yeah, that's the right week, Monday the 21st. We've already had the announcement from the People's Bank of China. They sort of announced it Friday. They said they were looking to raise rates by 0.25% on Monday. So Monday has come and went. And as you can see, the 1 and 5 year loan rates have been cut by 0.25%. What does it all mean? Well, it means they are behind the curve in Beijing. They are trying to help retailers. They're trying to help the house building sector. The 5 year loan rate is what mortgages are based on. The 1 year loan rate is short-term borrowings. But I just doesn't seem to have been enough. The market has done little. As I think the CSI, the China CSI 300 is up just over 1.25%, and I think Hang Seng is down from when I last looked. Yeah, it is. It's down. So I would call that a muted reaction in equity markets so far on the news of the rate cuts there. We've also got the start of the BRICS summit. It used to be called the BRIC, B-R-I-C. It now includes what is it? South Africa, that was it. Yeah. So Brazil, Russia, India, China, and South Africa attending, along with some invited nations, according to the notes that I've got. But that's a 3-day event. They're meeting in Kazan. That's in Russia. Yeah. Well, that's how Putin's going. He can't go anywhere else. He has to stay in Russia. So that's why it's happening there. Andrew Bailey, Governor of the Bank of England, speaking at the Bloomberg's Global Regulatory Forum in New York. Yeah, a few clues about interest rate cuts would be helpful. So sterling will be particularly sensitive to what Mr. Bailey says this afternoon. We then, sorry, not this afternoon, that's tomorrow afternoon, I do apologise. And the BRIC starts on Tuesday as well. So BRIC starts Tuesday, that's tomorrow, and Governor Andrew Bailey is talking tomorrow afternoon. So the only thing on Monday really to note is what's already happened with the loan rates out of China. Then we get to Wednesday, and we've got the Bank of Canada interest rate decision. So BOC stands for Bank of Canada, not British Oxygen Corporation, as someone asked me. We're expecting a cut of 0.5% to 3.75% as all these commodity currencies all reel from what's going on in China. Aussie dollar, New Zealand, I think the Reserve Bank of New Zealand, they cut 0.5% last week. So that's built in. CAD will be sensitive to that news on Wednesday afternoon. Andrew Bailey is speaking again. He's clearly a very, very busy man this week. This time at the annual meeting of the International Monetary Fund and the World Bank I think in Washington. Yeah, so he's spending the week out there, huh? Anyway, sterling will be sensitive again for anything that he might say or give any clues about interest rate decisions coming up. And then we have all of this data. It is just yards and yards of it. Manufacturing and service PMI data. PMI stands for Purchasing Managers Index. What I said at the beginning of my piece, that these surveys are from purchasing managers who report on the amount of money that's been spent, whether they're spending less or more. Obviously, they're spending less, then wherever they're spending it, that sector is falling. Anyway, following last month's poor Eurozone data, I think investors were going to be hoping for a recovery in the reports. The one to look out for is the Eurozone one, that is all of the countries combined. They do separate ones for France and Germany, but the ones we're really interested in is the key ones. And as you can see, it's pretty much unchanged, expected, slight tick up of 0.1. And the one to really look out for, you want to look out for individual countries, look out for Germany. Look how low that manufacturing index is. Below 50 implies the contraction in that sector. 40 is hugely low, is really, really low. Look at our much maligned manufacturing sector, obviously a lot smaller than the German manufacturing sector, 51.5. Yeah. Not the sick man in the G7, I hear you say. Okay, and then towards the end of the week, Friday, we've got this EFO. Yeah, I'm glad to see this being publicized a little bit more, certainly on Forex Factory. It should be read, really. It should be a high impact one. It's a large survey of manufacturers and builders and services and retailers, etc. And the Eurozone desperately needs Germany back on its feet. And I think expectations are for a slight improvement to 85.6, but it's very different from levels that this survey achieved before the pandemic. It's just chalk and cheese. Yeah. Durable goods, core durable goods. Sorry, where are they? Core durable goods. Okay, this is an interesting number. It excludes, the core means it excludes transportations items like cars, trucks, lorries, and aeroplanes. If an airline buys a ton of planes, it can really affect and distort the number. So it excludes transportation items. Nothing much to write home about. Minus 0.1% is the expectation there. And then revised University of Michigan consumer sentiment, good number. It shouldn't be low, medium impact. It should be high impact. It's expected at 69.6, so been revised up from 68.9. Obviously, you can see that in the way the stock market's performing, the way the interest rate expectations have continued to hold firm-ish. We've got that Goldilocks scenario. Consumers are happy, yeah? May help Harris in the run-up to the election on November the 5th. Who knows? Who knows? Anyway, that's it. It's 9:14. Yeah, I'm getting better at finishing earlier. I hope that's been helpful. Anyone got any questions? Anyone want to know why the planet does what it does? Why economists are the way they are? Do you understand it all? Good. Yes and yes. Yes, good. All right. Well, if there are no more questions, I'll finish for the session. Thanks very much for attending. No problem, Gary. Yeah, Paul. I sometimes wonder, I'm always in a quandary. Are people listening to me or am I explaining it really well? Anyway. Yeah, okay, Richard. Yeah, very interesting. Thank you. Most, but not all. Yeah. It takes a while for it to sink in, but it's not rocket science, really. It isn't. Thanks very much for listening and all the best. And we'll do it all again next Monday. All the best for now. Bye now.